Good morning, everyone. This is Mackenzie Sykes with the ASRS. Thank you for joining us. We are nearing the scheduled start time of the investment committee meeting. Please be patient while we confirm that our virtual participants are online. Thank you.
You've been swamped?
No.
Vice Chairperson McCarthy, the time is 9:30. We are ready for you to start at your discretion. Once you have called the meeting to order and the official roll call has been taken, I would like to take a moment and review the meeting guidelines. Thank you.
Very good. We'll call to order the meeting of the Arizona State Retirement System Investment Committee. It's June 25th, 9:30. Note the roll.
Will the following individuals please confirm you are present at the meeting by stating here as I call your name? Ms. Diane Landis.
Here.
Mr. Kevin McCarthy.
Here.
And Jay Petkunis is excused. Vice Chairperson McCarthy, a quorum is present. I would now like to read the guidelines and reminders. This meeting is currently being recorded and live streamed to the public. All speakers, please remember to identify yourself before speaking. Unless you are speaking, all mics should be muted to eliminate background noise. All cell phones should be set to silent. Once motions are made, I will take the vote by roll call. Once completed, the committee vice chairperson will announce whether the motion is passed. This will ensure it is clear to the public how each trustee voted and that the minutes are documented accurately. All presenters, please refer to the page numbers of the packet found in the upper right-hand corner of each page as you move through your presentation so attendees can follow along. If any members of the public wish to speak, you will have the opportunity under the call to the public agenda item 7. As a reminder, if a trustee needs to leave the meeting early, please be sure to verbally indicate when you leave for the record. Thank you.
Very good. Thank you. Moving on, item 2, the consent agenda, I believe is in your packet and is just the minutes of the March 26th meeting, I believe.
I move that we approve the minutes of the March 26th, 2025 meeting of the investment committee.
Very good. And I second that motion.
Hearing a motion by Ms. Landis and a second by Mr. McCarthy, I will take a roll call vote for the motion to approve the consent agenda. Please answer aye or nay when I call your name. Ms. Landis.
Aye.
Mr. McCarthy.
Aye.
Mr. Petkunis is excused. Vice Chairperson McCarthy, the vote has been taken.
Very good. Item 3, presentation, discussion, and appropriate action regarding the investment market environment. Ms. Dean.
Great, thank you. For the record, Rose Dean, partner at NEPC. So today I'll be presenting the first quarter 2025 investment oversight report. The market environment update for the first quarter was presented briefly at the May board meeting, so I'll just make some additional comments. If we move to page 14. So you can see from this page that the US stock market returns were largely negative during the first quarter. They were down anywhere from 4 to 9%, depending on the part of the market, whereas the international markets were relatively positive during the first quarter, up over 5%, with developed markets outperforming emerging markets. This was due to some fiscal stimulus plan that was announced in Europe, as well as the US dollar being relatively weak and translating those returns to even higher ones in US dollar terms. But after all the volatility we've seen this year, the US stock market is actually in the positive territory as of now, year to date. So just sort of thoughts about what is impacting the marketplace and investor behavior as of now. We largely boil it down to three things. First is the impact of tariffs and the implications of those to inflation and economic growth. As you know, the actual implementation has largely been postponed, and thus far, inflation numbers have come in relatively modest. But as the Fed chair noted last week, the impact of these policies are still likely to be ahead of us. So far, businesses have been able to manage their inventory and supply chain management relatively well without having to pass through the cost to their customers. But we're seeing now data come in that suggests that companies may have to start passing their costs through, given the fact that inventories are lower. Purchasing index survey has come in less optimistic. So as the deadline for the reciprocal tariff postponement is fast approaching in a couple of weeks, there's a potential for another large scale move in the marketplace like the one we saw in early April. The second is the impact of fiscal policy. So we saw the spending bill pass the House a month ago, and now it's up for a Senate vote in a few weeks. While there's expected to be some positive impact through fiscal measures such as tax cut extensions and additional deductions, et cetera, there are concerns about the fiscal responsibility and the impact of additional debt the U.S. has to incur to manage that fiscal deficit, which will be a higher interest rate impact potentially, which will be a potential drag on the economic growth. The bond markets have actually been relatively tame or calm thus far, and yields have actually come down. But again, there is another potential for volatility related to interest rates here. Lastly, obviously, the growing geopolitical tension. What we have seen is the impact on oil prices due to the Iran conflict. Again, there's more optimism with respect to how that's going to be resolved, but we've seen the example of how commodity prices can impact inflation in the longer term. The silver lining in all this is that the Fed actually has some ammunition here to cut rates. They're not stuck in a zero interest rate environment and have no more bullets to spend if the recession does materialize. But they're being patient about interest rate cut prospects. Having said all this, year to date 2025, the markets have been like a ride where sometimes you wanted to vomit, but then if you held on tight and you stayed on the ride, you actually kind of made it through and we're back into the positive territory, as I mentioned. So having said that, I'll turn to the oversight report to go over the ASRS portfolio, unless there are any questions about all this. Okay, great. I'll turn to page 30. So this is the summary of how the portfolio is meeting your ongoing objectives. This actually looks quite similar to that from the fourth quarter 2024, where the portfolio objective number 6 with respect to cash management has been fully met, but the other objectives are partially met. Where they are partially met, there's one common theme across the portfolio: performance versus the objectives. And that's that the objectives are not met in the short term, but they are met in the longer term, particularly 5 years and longer. So these objectives, one, risk-adjusted return, top quartile performance among peers, returns above assumed rate of return, and asset class returns above respective benchmarks. They are all being met over the longer term, and I'll go through the details in the next few slides. If we move to page 32, this shows the details of the total fund performance and the comparison to your peer universe. Just to orient you one more time, the total fund performance is shown on the top line on the table and also noted with the dark dot in the graph. Your policy benchmark performance is under the total fund return, and it's noted with the blue triangle in the graph. So for the first quarter 2025, the total fund returned 0.31%. And the 1-year trailing return is 4.88%. For that 1-year period, the portfolio did underperform the policy benchmark. And you'll see later in the report that that underperformance is really coming from the private equity and credit asset classes. These are the two asset classes where there is a large mismatch between public markets based benchmark and the private markets performance in the shorter term. And the board has approved that the benchmark for those two asset classes be changed to a private markets peer group based benchmark going forward, starting the new fiscal year. You can see over the longer term that the portfolio is actually outperforming the policy benchmark over all periods longer than 1 year. And the performance ranking among the peer group, which is shown in the parentheses, is in the top decile with the exception of the 5-year period. In terms of absolute level of returns for the longer term, you see that the 10-year return for the portfolio is at 7.67%, again, outperforming the policy benchmark. And for the 20-year period, that return is 7.35%. So your objectives of outperforming the strategic policy benchmark return, outperforming your peer group, and exceeding the assumed rate of return are all being met for the longer term period. If you turn to page 34, typically I would go over the risk-adjusted return in detail, but these metrics actually are really remarkably consistent over different time periods. So what we see consistently in different periods that we show here, 5-year, 10-year, et cetera, ASRS portfolio is in the top quartile, if not in the top decile, in terms of your risk metric measured in terms of standard deviation or the volatility of the returns you're generating over that historical time period, meaning you are one of the lowest in terms of low volatility among your peer group. That translates into this portfolio being in the top decile in terms of risk-adjusted return for all periods 3 years and longer. So we continue to see that the portfolio implementation is managed with the focus on generating returns at a prudent level of risk for the portfolio, which is one of your objectives. Now, I'll talk a little bit more about the asset classes themselves in terms of the contribution to the total fund return on page 39. We've noted that this objective of each asset class outperforming their respective benchmark was partially met. So that 1-year return column you see there, you see a large underperformance in the private equity asset class and the credit asset class. And this has been a consistent theme in the last couple of years where the public markets benchmark, so the public equities for private equity, and then the leveraged loan index have done extremely well. And in the short term, the private markets performance will lag. And you can see that impact actually reverses for private equity for the 3-year column, and it's actually outperforming. And as I mentioned, this benchmark mismatch has been changed and will be reflecting a peer group benchmark starting the fiscal year. But just to set the expectation, because we're implementing those benchmarks on a go-forward basis and we're not changing any historical benchmark, that mismatch will continue to be there for the time being until obviously there's enough history for the trailing performance to sort of get rid of that short-term mismatch. And I'll talk more about the private markets performance in a couple of slides. If we turn to page 42, just a quick note, given that there was a new asset allocation approved recently. At the end of the first quarter, the portfolio value was at 56.69 billion, and that's a decrease of about 100 million from the end of 2024. As of that end of first quarter, your asset classes allocations were all within allowable range, but private equity was a little over 13%, and that is now relatively close to your new target of private equity allocation of 13%. The interest rate sensitive asset class continues to be underweight by about 3% versus the 6% target, but that's consistent with the staff's outlook for that asset class, and that's an intentional underweight. Your real estate asset class is at 17%, and you'll hear from staff in a bit about their implementation plan to bring that allocation down to the new target of 15%. If we turn to page 45, I mentioned the performance of private markets asset classes. So the private equity benchmark you see here and the credit benchmark you see here, these were your secondary benchmarks, but now starting with the new fiscal year, this peer group based benchmark will be your primary benchmark for these asset classes. And the performance that you see here is an IRR, or a money-weighted return instead of time-weighted return. So this is taking into account how quickly the assets were put to work and how quickly they were returned back to the portfolio. For private equity, you can see that the IRR is actually below peer group performance for the 5 and 10-year period, but above the peer group since inception. And you'll hear from the staff shortly in terms of the breakdown of the portfolio. This is a relatively mature private equity portfolio, and you'll hear about the implementation plan for this portfolio going forward. For the credit and real estate asset classes, the performance is much more consistent over the longer term, and you are consistently outperforming the peer universe in those two asset classes. I noted this before, but I think this is important to, again, restate, and it's particularly relevant from the fact that you just approved an asset allocation in terms of the allocation to private markets here. You can see the absolute level of returns in private equity and credit asset classes are significantly higher than your assumed rate of return, meaning that allocations to these asset classes are really important in terms of your total fund being able to achieve a return higher than your assumed rate of return. So these are complicated asset classes, and there's a lot of thought gone into the portfolio construction and implementation. And as you can see, it has been very additive to the total fund absolute return. Last thing I'll mention is on page 46. So this is a summary of your asset class committee meetings that took place during the first quarter. There were committee meetings that took place where credit and private equity asset class implementation plans were presented and approved. And there were 10 manager recommendations that were presented and approved during these meetings. So overall, the portfolio is being implemented in a very prudent way with respect to not only the returns that's being generated, but also to the risk levels that are shown in historical performance. And the asset class committee meetings have been conducted according to the processes that were intended. And so there are no concerns and no action is being recommended by the committee or the board. I'll take any questions you may have.
Questions?
No.
I have just one. So I trust you do work all over the country with various retirement systems. You just mentioned the complications associated with the private equity, real estate, and understanding those. I think when I started on this board, we may not have even been in those deals. How often do you run into pushback from trustees that basically say, I have no idea what you're talking about when it comes to those? And my job actually is to know how this money is being invested and have some sense that staff is doing the right thing.
Sure.
Because I said, I don't know how many years I've been doing, maybe more than 15. And when we ebbed into this, I would admit, I'm saying it right into a microphone, I got lost in some of this. And if a reporter called me and asked me exactly what I was doing, I'd say, you know what, I don't know.
So I think your question is twofold. One is obviously the complexity of investments, and two is the governance model. So different plans that we advise have different governance models. ASRS is, I would call, a model in terms of a very effective and efficient governance structure where staff has delegation in terms of implementation of these asset class portfolios. Private markets in general, from an investment perspective, is, I would say, more complicated for not just the investment, actual investments in the portfolio, but also in terms of their reporting. There's obviously less transparency versus public markets, and you really have to roll your sleeves up and dig deeper into what's going on within the portfolio to understand where the returns are being generated, where the risks are within the portfolio. And that's exactly what your staff is for. Our role, again, and this is what you see on the screen, is a good example of how we provide our fiduciary oversight over this process. So every week there's an investment committee where these days a bulk of the manager recommendations and investment plans that come to these meetings tend to be in private markets. And it is our responsibility to oversee that the appropriate processes in terms of what's being discussed, how much due diligence is being conducted, and whether that process is prudently being approved by the committee or rejected. And that's our job as the board consultant, to let you know if the processes are not being followed and if the due diligence level is insufficient. So we do this on a regular basis, as I say, on a weekly basis, to say the staff is implementing this plan according to the processes that are put in place. Your question in terms of complexity, it's very difficult for non-practitioners who are not an investor directly on a day-to-day to understand the nuances and the complications of what goes on in terms of private markets investments. Do I see a lot of pushback? Over the past 10 years, I would say private markets have been a very structural part of public pensions, and there have been increased allocations in private markets, increasing not only within the allocation, but different types of strategies. Good example is private credit, which has become a significant portion of the public pension portfolio. So I would say it's much more accepted these days and is a significant part of most public pension portfolios.
Very good. Thank you. Appreciate
Mr.
that.
McCarthy, may I add to that?
Sure,
for me?
absolutely.
Number one, I think it's a great question. Number two, what I'd like to do is provide sort of a background information and then come to a conclusion on how we think through this. because I think it's really relevant. The markets have changed over the last 20 years. So 20 years ago, privates were a significantly smaller portion of investment portfolios. So really, boards have sort of a decision to make. Markets have evolved. So private investments were used to be a small portion of capital allocations. They're much larger. And portfolio theory basically says that the more investment options you have, the more efficient you can create a portfolio. So if a board determines, look, we don't have subject matter expertise in these areas, don't invest, they're actually constraining the investment opportunity. Expected returns will be lower and the expected volatility will be higher. So what did we do as an organization, Arizona State Retirement System? We thought about it from a governance perspective. It is not realistic to expect people that are appointed to boards throughout the country to have significant expertise because of the way the appointment process works. Typically, there's not qualification requirements. Now, there is in Arizona, we actually have investment knowledge is a statutory requirement for 5 of our trustees. But irrespective of that, we've got a governance system that's set up that says delegation of authority to experts. So if you look at the decision-making, the board oversees and the experts make the decision. That is one of the fundamental reasons why we went through this model. There's a couple of reasons. One, you segregate decision-making from oversight. That's a big one. But what's another big one? Delegation of authority to the experts. So that's how we've handled it. And then how do you get the feedback? There's 2 types of feedback. We basically have a bifurcation, feedback from staff and then independent feedback from the board's consultant. And it's set up by design. If you look at this agenda item number 3, independent reporting. Then what's agenda item number 4? Staff reporting. So you've got 2 information flows, one from subject matter expertise, which is your staff. Another is by an external consultant with subject matter expertise that reports to the board. So if you want to create an efficient portfolio and you have individuals that are overseeing that construction that do not have subject matter expertise, you have 2 options. Don't create an efficient portfolio because you don't have the subject matter expertise to do deep dives. That's one option. Another option is actually without the subject matter expertise, you do deep dives. And that is common in the United States. Boards will listen to detailed presentations to make allocations to general partners and other private market entities without the expertise. Then there's the third option, and that is a bifurcation between decision-making and oversight. Delegate to the experts, that's being done here at this agency, and have independent data sources to the board so that you can oversee. So that's how we respond to that question. Thank you.
You're good. Very good. Are you complete with yours? Or we?
Yes.
Oh, very good. Okay, moving on. Item 4, presentation, discussion, appropriate action regarding the asset class investment reports. Michael.
Thank you, Chair McCarthy, Board Member Landis. I'm going to actually ask each one of the staff members for the private markets that are presenting to actually give an example of a fund that they're investing in, just to put some color on it, to kind of dig down a little bit, just to give you a sense as to what we're investing in. I know we spend a lot of time, we use a lot of investment jargon, and because we work in it day to day, right? So it's kind of hard sometimes to step back and explain what's going on. So, and I know the team as a great way, they'll pull up some great examples.
Yeah, Mike, let me do the, on that point, this isn't a new issue, but Paul might remember for me and some of the other trustees, and a lot of time was spent, I think we probably spent about 3 or 4 hours upstairs in a meeting going through individual properties, for example, that we were invested in the real estate to try to give us an idea on that. And I hope my question didn't suggest that somehow I think that there's not a ready flow of information to the trustees. If I have a question, it's always been answered. The pit in my stomach just is fundamental, right? That I even with all of that, I can't keep track of what's going on in these areas like I can. Everybody knows how the public markets work, and you can see that. You can see our performance relative to what's happening on a day-to-day basis. So but no, I'd appreciate that added stuff, but we've had, or at least I have had a lot of feedback from Paul and the staff on any questions had in the private equity and real estate areas. So.
Great,
That, go
great,
ahead.
great.
Thank you.
I'll still have them kind of provide some type of color on our investment, just to kind of put a little meat on the bone, if you will. So, and this is the Q1 2025 Investment Committee report. Each one of the asset classes will be presenting on the quarter, just like we have in the past. We're changing up the lineup. So first comes up is public markets. So Cole and John Trusiak, if you can come up. They're going to be presenting their typical quarter report, so nothing changes. We've bifurcated this agenda item to public markets and private markets. So the reason we're doing that, because the private market folks will be presenting their implementation plan for the year. And really the implementation plan is all about the pacing study that's done. That's the heart of the implementation plan. So pacing in the context of private markets, so it'd be private equity, credit, real estate, refers to the strategic planning and budgeting of commitments over in the near term. In private markets, when we commit to any particular GP, any particular general partner, whether it be real estate or credit or private equity, they don't call the capital right away. We might commit 100 million to them, say we're going to give you 100 million. They'll draw down on it, called a capital call, over time. It might take them a couple years. They'll invest that, and then 5, 6, 7 years later, the distributions will come to us. We don't know when they're going to call capital. We don't know when they're going to distribute it. So we have the same effect in all the private markets. So that's the reason we go through these pacing studies. It's really to budget what the cash flow is going to be, to kind of come up with an idea and a very educated guess on what the cash flow is going to be, what the drawdown is going to be, what the cash flow is going to come back to us. So that in a nutshell is what the pacing study is all about and the implementation plan is all about. In public markets, if we commit to a manager, Cole's one of our managers, John's one of our managers. We want to give them 500 million. We just give it to them. They invest it right away. In private markets, that doesn't happen. It takes time for them to draw that capital down because they're out looking for opportunities. They'll find opportunities. They'll call capital from all the limited partners like us, and then it just moves forward. So that's really kind of the implementation plan and the pacing study in a nutshell. But in addition to that, again, they're going to try to give an example of what they typically see in their portfolios when they're underwriting something and how they go about the underwriting and kind of the type of investments there are. So we'll start with Cole, then move over to John. I'm going to exit stage left, so Al and Mike Copeland will come up as well.
Thank you, Mike. And hi, my name is Cole Smith, Senior Portfolio Manager for the Public Equity Asset Class here at ASRS. Thank you guys for your time, and please stop me anytime you have any questions. So if we could start with our performance, we'll be on page 59 of 189. Thank you. Okay, so here we present our performance as of March 31st. Total equity performance is in the top table, and we break it down into US equities and international equities in the following two tables. So regarding total public equity, we do continue to post incremental gains for the asset class. Now the fiscal year to date return there is of March 31st looks modest, about 3%. But I just checked as of yesterday, actually, our total return for the fiscal year is above almost 14%, it's about 13% currently. So we made a lot of progress over these last few months. Ms. Rose alluded to it, and I'll give some more detail on later. Now regarding the longer term returns, namely the 5-year, 10-year since inception, I'd like to point out and just note that all of those are above the 7% required rate of return for the total plan, which really is our most important goal in the long run. We want to be above the 7% required rate of return, and we've been doing so. Regarding the excess returns, we've made tremendous progress for this asset class since we implemented what we call our enhanced indexing methodology about 6 years ago. Since adjusting the way we manage this asset class, we posted positive excess returns in every single fiscal year. And just for a quick note on what that means is when we say an enhanced indexing, we are very close to our benchmarks. We take small active risk away from the benchmark, what we refer to as tracking error. We try to compound these small but positive excess returns over time. And again, they do add up as we can see here. If we see our 1-year and 3-year excess returns, about 20 and 21 basis points respectively. Now those have been positive for some time, but what I want to report today is our 5-year excess return is actually positive now for the first time. So something we've been working really hard to achieve. And I've been sitting in this seat for over a year now, telling the committee, hopefully by June 2025, I can come here and tell you that we're positive on 5-year excess return. And so here we are, and we're very, very pleased with this achievement. Of course, we're steadfast on getting that 10-year positive as well. That will take time for these underperforming strategies to slowly roll off, but we will certainly get there. Regarding the next two tables, the key takeaway here is really that US equities have outperformed international equities across all time horizons. Now, fortunately for us, the way our benchmark is constructed, we are 2/3 US equities, 1/3 international equities. So the fact of this US outperformance has really helped us, just given the way our benchmark is constructed. So if there's no questions on performance, I will move on to the next page, page 60, 189, please. So here's some basic asset class statistics here. We start in the top left. We see that total public equity is still the largest asset class within total plan, about 24.5 billion as of March 31st, just about 43% of total plan. Now we manage 2/3 of this asset class in-house, my portfolio managers like myself. The other third is managed externally by index managers like ourselves. We've adopted this enhanced indexing across the total asset class. On the top right, we see our portfolios compared to our benchmark. And you can see here as of March 31st, there are no active tilts to speak of in any location, any region, or any size of the market. And it goes to speak how we stay very close to the benchmark and just try to get these small incremental returns to outperform. In the bottom left, we have the sector weights that make up our benchmark and thus our portfolio. As with prior quarters, information technology is still the largest sector, and that's followed by financials and industrials. In the bottom right here, we see the top 10 portfolio holdings. Again, as with prior quarters, these names don't move too much. What we see here, though, is this is really the Magnificent Seven that we hear of so often. If we add Broadcom there and Berkshire Hathaway, that rounds up the top 10 holdings in our portfolio. Yes, please.
So maybe it's been there before and I just haven't noticed it, but I see that, I'm assuming they're ANC shares. You have Alphabet listed twice.
Yeah.
And so, and you're saying those are the top 10 holdings. I think the shares are virtually identical. So why wouldn't you add whatever the true 10th might be?
Certainly, yeah, we keep it this way because that's how the benchmark actually holds them. They hold them respectively. So that's when you see the Alphabet, that Google shares, they are listed in the benchmark different, but you're 100% right. If we were to add those two together, they'd quickly jump in there and we could probably make room for another one. But
It would make it a higher percentage of, it
would.
would overtake, I think it's Meta's what's there.
Yeah, it probably would take Meta and probably even get close to overtaking Amazon as well. That's the case. We could certainly consolidate those if you'd like to see it that way. And we'd probably bump in another one, which next in line would probably be JP Morgan or Tesla.
Because it's a truer view of the top 10.
Sure. Absolutely. Yep, we can certainly add that next quarter.
And how much we have in it. Thank you very much.
Of course. There's no more questions. I'll move on to the next page, please. Page 61. Thank you. So here to present our house views here. A lot of this Rose has already mentioned, so I'll try to keep it a little bit brief. But when we presented the committee in March, we knew that some major policy decisions were on the horizon. Now, when Liberation Day came, or April 2nd, these tariff announcements were perhaps a little bit more extreme than the market expected. The market did sell off accordingly. At one point, the S&P 500 was down 19% from the highs we had reached in February, just shy of a bear market, which is defined as a 20% drawdown. Now, fortunately, there was a little bit of reprieve on these tariffs, and then we've got the 90-day pause to allow for negotiations on the majority. Markets were encouraged by this, and as Rose said, we have a V-shaped recovery, and actually left the S&P 500 in positive territory for the year. We're just about 4% up for the year on the S&P 500. Now, underneath the hood there, if you look at what's driving these gains, there's been a rotation in the sectors that are driving this. So prior to 2025, the tech sector and communication sectors were really the perennial favorites driving gains in the indexes. And again, this is because they house the Magnificent Seven for the most part. But since then, and since the start of the year, we had this unique combination of a couple of defensive sectors and a couple of cyclical sectors that are really driving the gains. So they've been doing very well this year. But in the sectoral, I guess, rotation is healthy because this helps alleviate some of the concentration issues we've had with the tech sector and these Magnificent Seven names being so top heavy in the indexes. Now, but despite this rotation, the Magnificent Seven still makes up about 30% of the S&P 500. So we've made some progress. You know, we're up to about 37% at one point. Not as concentrated, but still pretty concentrated in the major indexes. So if we go to the third paragraph here, we can I reference the valuations. And we reference our valuations and we measure them by the forward price to earnings ratio. What we're doing is we're taking the current price and dividing by the next 4 quarters of expected earnings. This gives us an idea of where the market is, what we can expect, and how we can measure ourselves against the past as well. Now this 22x or 22 times PE is high. It's about 30% higher than the long-term average. Excuse me here. But however, I do want to mention that valuations are not great predictors of returns in the short term. I think it's important to keep that in mind. Just because we have a rich PE or a rich valuation doesn't mean it doesn't necessitate lower prices in the indexes. But what it does mean is markets are much more sensitive to risk-off events. So we're much more vulnerable to corrections and they can happen much quicker. It's due to this concentration in the market being overvalued, if you want to consider that. So these corrections can come quick. We've had the one this year and a couple last year as well. I'm going to look ahead here. So looking ahead, both earnings and price targets have been revised lower since the April 2nd announcements. So when we started the year, the median target for the S&P was about 6,600. Now that current median target is 6,100. So revised quite a bit lower. Earnings have also been revised lower as well. Now, consensus often underestimates earnings. I know I can bring a chart next time here, but if you look at where analysts expect earnings to be, almost every single quarter, they underestimate earnings going forward. So while we have a consensus expecting 7% earnings growth for the year, it's not out of the realm. We could actually see double-digit earnings growth. If we see double-digit earnings growth, earnings drive prices, we could certainly see the S&P 500 and markets climb higher through this year and even reach the targets we had at the beginning of the year. But there's considerable uncertainty we have to overcome, namely trade policy and fiscal policy. So if we can get past these big hurdles, we could have a great second half of the year, but time will tell. But those are all the remarks I have prepared. Sorry for being so quick there. Please ask me any questions if you have any.
No, I don't think we have any questions. Thank you, Cole.
All right, John.
Great. Hello, everybody. Great to see y'all in person as well. My name is John Truziak, Portfolio Manager for Fixed Income. We can go to page 64, please. Great, thank you. So on this slide, we'll start off looking at the performance for this asset class, the interest rate sensitive asset class. So for the period ending 3/31, you can see the roughly $1.8 billion market value. It makes this asset class the smallest asset class within our total fund, but nonetheless still an important use for us internally. So looking at the performance for just the 1 year and fiscal year to date, you can see that the asset class actually produced performance that I'm not usually telling this group. You know, you're looking at performance through March 31st of 4.45% for the asset class. And when you compare that, you know, to the 3, 5, and 10 year, you can see that this asset class is basically given 0% returns to the total fund, but also for the benchmark worldwide, et cetera. And I think that's just an illustration of how treasuries mainly have performed over a 3, 5, and 10 year period, really offering no return upside, a lot of volatility, which I'll touch on. But nonetheless, it did have, this asset class has had a good performance for the 1 year and in the last quarter as well. And then just touch on the outperformance. You see 3 bips for the quarter. I checked this morning, we're at 7 bips outperformance. So we do keep scratching and clawing with regards to beating our benchmark. And I'll touch on reasons for why we've had some benchmark outperformance later on in this presentation. And then, of course, I do want to mention it's 97% internally managed, meaning myself along with the staff internally manage this asset class. We have a very small allocation to an external manager, which, as I've said in the past, we really use that external manager for times of liquidity. When perhaps there's liquidity needed for other asset classes, we draw on that manager versus taking from the internally managed account. Next slide, please.
I do have a
Go ahead.
question on that.
Yes.
So I'm assuming you're holding individual treasuries,
That's correct.
so are they held to maturity?
So a lot of the treasuries in the portfolio, the internally managed portfolio, are held to maturity. However, we do sell treasuries and buy treasuries that are on the run or off the run. Meaning on the run treasuries are treasuries that were just issued from the US Treasury Department. And then off the run treasuries are treasuries that were basically already issued at varying different maturities. And we do that to rebalance the portfolio. Of course, there's a benchmark where we're trying to replicate. And so that causes the need to rebalance the portfolio daily, weekly, monthly, whatever tilt we view and see. So a lot of treasuries are held to maturity, but we are also able to sell treasuries before their maturity date.
And I don't know if this is a question that makes any sense or not. I'm assuming, maybe I shouldn't be assuming, but one of the purposes of the treasuries are to pay out monthly payments to our retirees. Is that correct or not correct?
So
Or do you have to make sure there's cash for that?
Yeah, so we really view this asset class as a use for liquidity for the fund. We do capture income from the treasuries that we own. That income comes into basically this asset class's account. And then whenever there's money to be needed by the total fund, we can use this asset class to transfer it to the master cash for the total fund.
Typically, there's been a good amount of cash flow coming from private markets. So private equity is a pretty mature portfolio. Real estate has been a pretty mature portfolio. Also, it's been kind of coming down in its allocation from 20% a few years ago to 17%. And now with the new asset allocation policy, 15%. But that's throwing off a lot of cash as the rents.
That cash,
To use everything
everything,
to
okay.
pay. And if we need to come up with cash.
You're not reinvesting or
We actually haven't had to draw down on public equity or interest rate sensitive in months because the cash flow from private markets been robust enough to pay for the retiree run and all expenses. So it's a good position to be in.
Thank you very much.
But it's a great question.
Yes, thank you. Great questions. If no other questions, I can move on to the next slide, please. So on this slide, it's portfolio characteristics of the internally managed account, which I mentioned is 97% of that $1.8 billion market value number you saw on the previous slide. So these are just characteristics, so you can see, you asked the number of treasuries that we have in the internally managed account. As of 3/31/2025, there's 247 specific securities that we held, and 92% of that, like you can see on the bottom right chart, are US treasuries. And the other 8% make up corporate bonds, which we are also allowed to purchase in this internally managed account to help be accretive and help outperform the benchmark as part of our asset class implementation plan. So that's just like I said, a good summarization of the internally managed account. And then you can see on the bottom left the benchmark yield to maturity, which also closely reflects our internally managed accounts yield to maturity. So you can help understand the amount of income that we are receiving from these securities that we hold. But I do want to, it's been kind of funny always looking at this bottom left chart because I always, I put these slides together and then I check it day of when we come to report. And Rose actually mentioned this as well. The volatility in the treasury market from year end to 3/31 to now, there's been a lot of intra-quarter moves, but really what we're looking at is basically treasury yields where they have kind of ended at each quarter ends. They're near where the last quarter was. So for example, March 25 was a 4.11% yield to maturity. And right now we're at 4.10% on the benchmark for yield to maturity. Whereas when I usually check this, there'd be 20 bips of volatility. And I'd always chuckle to myself. Granted, in this past quarter, there was a lot of volatility in April and May with some of the political headlines, Liberation Day, et cetera. But anyhow, I just wanted to make that comment as I was chuckling to myself when I checked that this morning. Any questions there? Okay, moving on. Next slide, please. So in summarization, again, with the performance of this asset class, the 0% returns for the 3-year period, negative returns for the 5-year, 10-year period, we continue to view this asset class deserving and a weighting that is less than our interim SAA as well as our SAA. So we have about a 3% weighting to this asset class as of today, and we continue to recommend that internally. And the reasons we recommend that is just opportunity costs of other asset classes where we believe we can meet the fund's required rate of return better in other asset classes versus this asset class. However, though, it can be used as a source of liquidity, which we haven't used it, as Mike Viteri said, in a couple months, drawing from this asset class as a source of liquidity, but it's there if we need it, which is, of course, a great feeling. And then just interest rates, there's all this news about the deficit. The deficit can drive where the long-term interest rate is. There's a lot of stuff in the news right now calling for the Federal Reserve to make cuts to their interest rate. This creates short-term interest rates to move. The Federal Reserve helps control short-term interest rates. The market largely controls kind of the longer-term interest rates. So there's still a lot of newsworthy happenings for this asset class that we continue to monitor on a day-to-day basis. But with that being said, very happy with how it's performed in the past three months, past year, even though it hasn't met its, kind of the 7% total fund return, but we continue to outperform the benchmark. And with that, I'll take any questions. And if not, thank you very much for the time today.
Thank you, John.
We'll move on to Mike Copeland. You folks know Mike as the face of real estate, but actually he only spends half his time in real estate. He spends the other half of his time in private equity. Sammer is out today, so Mike is stepping in. Mike, take it away.
Thank you, Mike. Good morning, members of the board and trustees. My name is Mike Copeland. I'm the senior portfolio manager of private markets, focuses on private equity and real estate. So to start off on slide 69, please. See over the returns. So the private equity portfolio has outperformed over the short term, the 1 and 3. It's largely driven by manager selection. Manager selection is the primary driver of returns in private equity. And it's also driven by our co-investment separate account, which was created about 2 years ago. Off to a very strong start already. Excuse me, with a 22% net return and a 1.2 net multiple, so no J curve. And it's already close to 8% of our, or 10% of our portfolio. Over the long term, you see underperformance relative to the MSCI private equity North American and Europe universe, which would be the official benchmark starting 7-1. This is largely driven to strategies that were geared towards like distress for control, value oriented, and also very significant energy overweight within the portfolio. I think the energy investments in private equity peaked at around 18% of the total portfolio in 2018 or so. Those are difficult to exit as the market, public energy trades at sub 5 multiples to EBITDA. And so the positive is that they are throwing off a lot of cash. The negative is that we can't really, our managers have difficulty selling anything for the last 4 or 5 years. If you can move to slide 71. This shows how the private equity portfolio has performed relative to various public benchmarks since inception. And as you can see, we do, as, Rose from NBC mentioned, we have a very mature portfolio. And, especially since 2022, you can see since inception is outperformed, across the board, across Russell 2000. The official benchmark is the Russell 2000 ACWI Blend, and then also the MSCI ACWI World Index. One of the things we focus on, if you turn to page 73, is improving our manager selection. And this is a slide breaking out our portfolio by vintage year and quartiles. And there's a real penalty for getting it wrong when investing in private equity. The since inception aggregate return of first quartile funds is net 23.3% return. And for fourth quarter funds, it's a 2.3% net return. And so, with that, we have constantly evolved our underwriting and our fund selection. And Samar and I started working on the portfolio in 2019. We made some pretty significant changes as far as strategy, with a more focus on number one, buyouts, and not only buyouts, but growth buyouts, where managers have a real operational functionality to more control and manage investments. And just to touch on what Mike said for pacing, whenever we commit to a capital to a fund, we're not investing, within 3 months. It's a 10-year contractual fund life. Number one, the average buyout fund is a 14 years duration. And within the first year of investment, less than 10% of the capital is called, typically. And so, the way we look at funds is kind of like a three-legged stool. So the first leg of the stool is the strategy itself. What geographies is the manager investing in? Is it sector focused or across sectors? A lot of managers in our portfolio that we've been committed capital to are typically investing between 2 and 3 sectors, or a single sector, as they have, more depth in the market. They get advantage sourcing, so they could buy things typically cheaper. And then they have operations teams that are specifically tailored to those sectors to then create value once they own a business. And then they typically have a large percentage of their fund investments to be sold to strategic buyers, like public companies, or sponsor-backed companies that have a lot of M&A in their strategy. And so that allows them to have a premium on sale relative to what they can get if they sold it to another sponsor. And our predominant exits in our portfolio, less than 10% are through public markets. They are private transactions, the vast majority of them. With an IPO, our venture capital partners do that a lot, but it's typically a 2-year lockup once the company does IPO. And then the second leg of the stool is the team itself. Do we think the team is capable of executing on the strategy and scaling the strategy to produce top returns? And then the last leg of the stool is the evaluation of the track record. And over the last 6 years, we've added a number of different tools to disaggregate performance, to really understand exactly how the manager is creating value and producing value in their track record, and who are the partners creating that value, and are they and there's a lot of questions underneath each of those legs, but that's how we have focused on and how we think about investing in managers, and then how we've seen for the last 3 years above a 50%. And you could never get it, no one bats 1,000, as they say in baseball. And it's also true in investing. And so the goal is really like to, have 60% plus of every vintage year to have above, have first and second quartile funds. And the other thing is we have over 90 individual GPs in the private equity portfolio, and we're focused on rationalizing that number down to around 40. But it takes a lot of time to do that as funds wind down. The other penalty for fourth quartile funds is that the duration is a lot longer. And so, the companies aren't performing, they can't sell stuff. And so it's, there's about 10% of the portfolio where they're in years 13, 14, 15, 16, and it's the downside of, private equity is that you don't have, as an LP, real ways to force the manager to sell companies.
Curious, do you have managers come to you soliciting you, or do you go find managers, or is it a little bit of both?
Good question. So I'd say there's 3 ways we source. One is renewals, 2 is placement agents, and then 3 is a combination of managers reaching out to us directly, or and it's one of the benefits of our separate account partner. They've been also making fund commitments for decades, and so we've leveraged them as a sourcing and sounding board for managers who might be thinking about, see who they're thinking about making commitments to. But we get solicited every single day by, 10 or 20 fund managers and placement agents. And so it's like a fire hose of opportunity, I'll put air quotes, opportunity. And so typically, at the end of the day, we underwrite and make commitments to about 8 to 10 funds a year.
Thank you.
Michael, you gave the example earlier about 100 million we're gonna reach some agreement, and it takes multiple years to draw that down. Where's that money in the interim? Is it cash on our end, or it treasuries? Where's that money? They don't have it, right?
They don't have it. It's committed. They haven't drawn it down. Maybe they haven't drawn it down for 6 months or a year. If it's 100 million, maybe it'll be $1 million or $2 million. It's invested in the rest of the portfolio. So in the case of private markets, if we go to page 74, please, you'll see the cash flows that private equity has been able to throw off. So we end up getting these cash flows every day. That's reinvested. It's either equitized, basically using futures. If it sits in the cash account, if the cash account ends up being big enough, we end up distributing it to other public markets, whether it be public equity or interest rate sensitive. But there's typically enough cash on hand to pay for pension rate run and capital costs. So that's been the case for the last year. We really haven't had to go raid public equity or interest rate sensitive. So the cash is there, but it's being invested. We don't just let it sit there in cash.
Yeah,
That said,
confident
cash
of
is
that.
providing a 4.3% return.
Yeah, I was confident that, well, I guess what I was trying to understand, does it bleed over into any of the other silos, public equity? Or when we're looking at this, are we potentially seeing that we've got more money actually in the silo, but it's being parked elsewhere at the moment?
So the asset allocation that Rose presents on, we end up getting daily reports on the cash that's come in, what's available in what we call master cash. That's producing 4.3% return. And we're forecasting the drawdowns that happen every single month. We have a 10-day lookout on the capital calls that are being drawn from the different private markets. So private equity has to give us, the different GPs have to give us a 10-day notice when they want a capital call. Same thing with real estate, same thing with credit. So all those demands in cash, the cash that we have, the cash that it's demanded for pension run, we're managing all that on a day-to-day basis. And so that ends up being kind of Lupita and her team. But it's all invested at a given point in time. So in many cases, what's in cash is actually being equitized. We have futures overlaying that. So we're able to get public equity or interest rate returns on that cash. I don't know if that answers the
Yeah.
question. I've gotten too technical. But
Does,
it's,
thank you.
it's not just sitting there in cash.
And Chair McCarthy, if I may, best way, the way I think of it is there's two terms. One is committed capital and one's invested. So they make a commitment to $100 million to a fund. That's called a commitment. And then there's drawdowns through time. When there's money taken, it becomes invested. When we think of our total portfolio, we only consider the invested money there. So if we say how much is in private equity, it's how much is invested, not how much is committed. We keep track of that, but our decision-making, the economics of it is driven by the invested capital. The economics is not driven by the committed capital.
Okay,
Thank you.
appreciate that.
Mike, if you want to hop to page 80, go to the implementation plan, please.
Oh, yeah. Move on, okay, the phasing plan?
However, I just, we're running low on time, so.
Yep, understood. So for 2025, for our pacing, if you go to 81, we're making 1.4 billion in new commitments. 30% of which is allocated directly to our separate account partner for co-investments. And which is approximately 400 million. And we expect that, to maintain 13% allocation to the total fund, that this pacing amount is relatively stable over certainly not certainly, but probably over the intermediate period over the next 3 to 4 years of making 1.4 billion on new commitments every year. But, Axia is our consultant, private equity consultant, and so they will rerun this model in the fourth quarter, and we'll come back with a new commitment amount for 2026. The strategy is largely the same, focus on buyouts, a little bit of venture capital. And one thing is important to note about the cash flows that Mike alluded to is that our portfolio has been more or less cash flow neutral or positive since 2017. And over the last 2 years, it's been a very challenging market. Transaction activity is significantly down. And we still had a neutral cash flow between capital calls and distributions. That compares to our peers of around 0.4. And so we feel pretty good about the amount of cash that the portfolio is generating. We had a very strong first quarter, but post-Liberation Day, things slowed down quite a bit. But we've heard anecdotally from our partners that over the last 3 weeks or so, activity has really picked up in the market, which means that probably fourth quarter might be a pretty good quarter for distributions and activity. Any questions on private equity?
Could you give a 90-second example of an investment you did recently? The number of portfolio companies that GP might have, the nature of that, just to give them a sense as to what a private equity investment is like, please.
Sure. So this one actually is closing Thursday, but it's a commitment of $100 million to a manager based in DC who's focused on government regulated industries. So about half of it is aerospace and defense, and then about 25% in technology and the rest in healthcare. And that manager is, because of their strategy, a number of their partners have the highest security clearances that you can get in the US government, deep relationships across the federal government, primarily on the career civil force, civil workforce as compared to political appointees. And so their average, and so it's a $4.75 billion fund. They are going to make between 12 and 14 investments. The companies they're investing in, when they buy the company, it's sub 10 million of EBITDA typically, and then they'll make 7 to 10 add-on acquisitions to scale that company up, and then ultimately sell it with the goal of selling it to a strategic buyer. And the other interesting thing about the strategy is that they're focused on family-owned, like family and founder-owned businesses, rather than sourcing through other sponsors. So that allows them to pay a lower multiple than market. And it, so then you get a pretty significant amount of the gains coming from multiple expansion. Because they're buying at a discount to market, then they're typically selling above market because they're selling to strategic buyer. And usually, you know, they're buying at around 9 to 10 of EBITDA and then selling at 14 to 15. And in the meantime, because they're doing all the acquisitions, they're growing EBITDA and revenue. And then they're also making operational changes to usually professionalize the C-suite, you know, allow the company to hit adjacent markets, to become more important as a customer or provider to the federal government, as well as state and local governments.
Thank you, Mike.
Appreciate that. Thank you.
Absolutely. Mike, if you want to introduce RCLCO, since this is kind of also your area of real estate. I'm not sure who's going to present, whether it's Taylor or Cindy.
Yeah, so I'll just start off before that with the returns. So on page 87 is the real estate returns. The IRR is more indicative of returns than the TWR due to the lag. In real estate, we take a much more concentrated approach. 85% of the portfolio is managed by our separate account partners. This is resulted in, you know, outperformance across every time period. And I'll just give an example of what we're doing. One is we have a separate account partner that's investing in data centers. And so we committed this manager in 2021 and set up the setup account. Originally, it was a barbell strategy. So, you know, stabilized core assets on one side of the barbell and then development on the other side. Sometimes you get lucky as far as timing. And so when we committed to the manager is before the AI boom that you saw from NVIDIA and the hyperscalers. And so the strategy is now we've acquired one core asset, but now we have 3 development assets. At 12/31, when they were appraised, they were actually appraised at 3x our invested capital. And so it's, you know, and there's a significant amount of appreciation in those assets because there's restrictions on new supply that are very real, with power being the major one, and then various municipalities getting much more stringent on entitlements. And then the other, and then on the tenant side, the tenant demand is insatiable. And not only are the 4 or 5 hyperscalers as major tenants, but then there's other players that are entering the market and trying to get access to data centers, as much data center access as possible. With that, I'll turn it over to Cindy Thomas from RCLCO Fund Advisors to go through the pacing and save some time.
Great. Thank you, everyone. Appreciate the opportunity to be here. Cindy Thomas, I'm a managing director at RCLCO Fund Advisors, and I will run through the implementation plan starting at page 94, please. So wanted to start here with the dry powder within the separate account portfolio. Paul mentioned earlier the timing of committing capital to each of the managers and how that gets drawn down over time. Within the real estate portfolio, there's an additional nuance where we certify through the investment committee at RFA, which Mike and Mike attend these meetings on a weekly basis, but we certify each investment individually. So while we may have called, like in this case, almost 5 billion, there's an amount that's been committed to investments that hasn't been called yet. And then there's also recallable capital. So that leads to sort of a different dry powder number than we would have expected if we're just looking at straight invested and committed. So there's.
If I may, so she
Yeah.
mentioned certified. So typically we have about 18 GP relationships in real estate. If they're interested in a certain property or doing a certain development, they'll bring that information to ASRS and RCLCO. And that's where the certification process comes through. It's a research process, goes through a first certification, second certification. Once RCLCO, they have their own investment committee. Once they approve that, it goes to us, whether or not we want to approve it. If it happens, it typically does, but in some cases it doesn't. But that's the certification process. I just want to put a little more color there, a little more involved. Thank you, Cindy.
Yeah, appreciate that and really bring it up, number one, just to clarify this slide around, true dry powder within the real estate portfolio. But also just to let, everyone know that there is a pretty significant and rigorous process, even though dollars have been committed, at the investment level, really on a weekly basis.
Trustee Landis, you had a question?
Yes, I do have a question under, I guess it's residential preferred equity. You show more called than committed.
And that's true. And most of that is because of the recycling that's happening on a regular basis. So while a certain amount might have been committed, it's already come back, sort of round tripped, if you will, and been distributed. And then within the different separate accounts, it's available to be called again. And that's what creates that nuance.
Thank you.
So if we move to the next slide, slide 95. So we expect to invest that remaining capital to the dry powder to the existing managers and really continually actively manage the existing portfolio through disposition activities. So dispositions at the investment level are targeted really at an asset by asset level through an annual hold sell process that's focused on, not really history, but what that asset is expected to, how that asset is expected to perform over the future. So we reforecast returns on an annual basis for each asset. And then also we're recommending committing here fresh capital to new managers that are executing on high conviction strategies. And I'll get to that in a minute. So while we were initially at a 17% target for the real estate portfolio, we're now at a 15% target. And we expect to reach that level, as you can see here, within calendar year 2026. Again, still being able to actively manage the portfolio through dispositions, run out the existing commitment to managers, and then also commit to new high conviction strategies. So if you move to the next slide, please, page 96. This is just a graphical depiction here of the previous table, but does compare to the draft 2025 plan, which was based on that 17% target. So you can see that in the green line. The blue line is, today's forecast based on the 15% target. And then also just shows for comparison purposes how quickly the portfolio would run down if we didn't make any new commitments, which I'll talk about here on the next slide, please, slide 97. So here we're focused on new commitments, again, high conviction strategies based on the research that we're doing, you know, really on a daily basis, but certainly on an annual basis when we're looking at a deep dive for the pacing plan. And you can see here, number one on the list, we're focused on a new commitment for industrial strategies. We are tempering this a little bit. So while we think it's prudent to do a $400 million commitment, we'd like to proceed with caution based on the tariff disruption. We're not really sure where the tariff story is going to land here, right? And through April and through May, there's obviously some potential headwinds there. So what we'd like to do is commit an initial 100 million with an ASRS only right to upsize that an additional 300 million over time. Mike mentioned data centers. It's a very high conviction strategy. Timing is everything. ASRS has a manager that has access to land sites with power and development capabilities in the right locations. And so that's something we want to take advantage of. That right already exists with the manager. So this is one of those where it's an ASRS upsize of 200 million. And then multifamily, we're recommending 300 million there. And as the remaining commitments are exhausted, so again, back to that initial dry powder screen, we are strong believers in all things associated with LIV. We all know there's a shortage of housing in this country, and it's a really a demand-driven asset class that we've been behind for many years. If you, and then I'll just say, really leaning in across the risk profile to value enhancement type strategies. So where we're creating the value with the manager, maybe through a renovation, a lease up play, also construction where we think it makes sense. LIV, I mentioned, and then industrial, again, proceeding with caution. So on the next slide, we can see here just a few things to mention because I know we're short on time. Again, we expect to be in compliance, remain in compliance, and really achieve that target you can see here in calendar year 2026. And the forecasted draws and distributions, you know, what you're seeing here really is just active portfolio management again. So we're committing to new strategies, we're drawing down existing commitments, we're selling properties, we're distributing cash flow for those properties that are stabilized over time. And on the next slide, 99, again, around compliance, just a few things I note here. Over the long term, we expect to remain in compliance with the set model allocation. You can see in the top left chart, the majority of the investments are equity. Most of the debt in the real estate portfolio is being shifted to the private credit portfolio, although there is a small piece here that will be maintained within real estate. On the risk profile chart, again, we continue to cycle as necessary out of stabilized assets when that's deemed accretive in favor of more value add. And so this just again speaks to the active portfolio management, buying and selling that's going on within the real estate portfolio today. Again, we recommend an outweight to all the LIV strategies. And we continue to favor separate accounts where ASRS really has more control over their destiny, has liquidity rights, you know, which is very important and has proved worthwhile as we've moved the target from 20 to 17 and now to 15 over time. Mike, let me know if you want to continue on the other slides. I think I've hit it. I'm happy to do that, but I know you're short on time.
Chair McCarthy, Board Member Delandis, do you have any other questions on real estate? So the theme ends up being about the same implementation plans for each one of the private market asset classes, how they're budgeting for the future, given the nature that managers call, it's unpredictable and the cash flows that come out unpredictable. It's really just, it's a pacing study. We'd probably give one more example in this asset class on multifamily, if you like. Mike could probably speak to that.
Sure.
The multifamily you're familiar with. Mike, could you speak to a multifamily investment we've done, please?
Sure. So our largest, one of our largest relationships is Mill Creek Residential Trust. They're second or third largest apartment developer in the country. Markets nationally, so from Boston to Florida and then across to Southern California and north to Seattle, as well as Nashville and Denver. And so we made, we're not only invested into the operating partners with them at the operating company level, but then we're partners with them as an LP to do multifamily development. We've committed $1.5 billion into multifamily development and helped them launch their single family rental development strategy, which is townhomes predominantly, as well as single family detached homes, with a bias towards the larger units with more bedrooms. Typically, a multifamily building will have 85% to 90% of the units will be studios, 1 bedroom and 2 bedrooms. So, you know, as millennials age and then start having kids, which has happened, they want to move out of the apartment into a single family house. In a typical apartment, you have 70% have pets. The single family house, the townhouse provides outdoor space for pets, and which is an attractive feature. And so it's really kind of a, you know, affordable housing for families in locations that have good school districts is really the focus.
How much
But
did you say we have invested with this partner?
1.5 billion
Oh, okay. I thought I heard.
on the
million.
LP side.
Yeah, I heard million and I thought.
No, it's,
Couldn't have made a mistake.
yeah.
Okay. Yeah.
And then
that-
about 500 million on the platform, so $2 billion total relationship.
Okay. Thank you.
Thank you, Mike. Al, on credit, thank you.
Hi, Al Alemo, I'm Deputy CIO. I'll be talking about the credit asset class. I'm gonna move around a little bit. If we could start on page 133, please. I just want to remind everyone what the credit asset class is. It's focused on debt obligations, bonds or loans to companies or individuals, where the primary risk is the ability to borrow to perform on the debt obligation. Example, pay interest on time, not violate covenants, and repay the debt obligation, loan or bond as agreed. Because some borrowers inevitably cannot repay their debts, bonds and loans may become distressed, which can lead to attractive investment opportunities for new investors. And we in fact have 2 distressed debt strategies, not a big part of what we do. They actually purchase distressed loans from the original lender. And I just want to make sure that remind everyone that the credit asset class is comprised of riskier, below investment grade debt obligations, both performing and distressed, which offer much higher potential returns and are less sensitive to changes in interest rates than the investment grade corporate credit market. Just want to make sure everyone knows what we're talking about in credit. We talk about it every day, but it's not a common asset class in the broader world. If we could turn to page 106, please. 108, sorry, 108. Just to go over performance. So big picture, we've been investing in this asset class starting around 2008, 2009, opportunistically post the great financial crisis. And then in 2012, we created an asset class investment in private debt that's now been aggregated into what's now known as a credit asset class. But the bottom line is this asset class has generated returns that have exceeded the 7% return target in all periods. So it's been a valuable contributor to the performance of ASRS over a long period of time. Recently, if you look at the top of this page, you'll see compared to our current benchmark, which will end as of June 30th with the adoption of a new benchmark, our performance versus this tradable loan benchmark, it underperformed for the 3-month period and the 1 year and the 3 year. But over the 5, 10, and since inception, it's performed quite well versus that tradable loan benchmark plus an illiquidity premium of 2.5%. If you compare it to a benchmark of private investment opportunities, private credit in the US and Western Europe, which aligns with how we invest, this new benchmark, which we're adopting effectively as of July 1 with the new strategic asset allocation plan, has outperformed in all periods. And you can see that in the second row of numbers. Just want to see if there's any questions on that. Sorry, thank you. If you give in the interest of time, just move on to the next page. It just simply, you'll see the growth in the asset class since we created the kind of combined credit asset class in 2008, fiscal 2018. It's grown from 6.6 billion to 12.2 billion. It's grown from 16.6% of the fund to 21.8%. I'm just going to move on. And on page 54, you'll see, I'm sorry, the next page, which is page 110 rather, you'll see that the credit asset class in the last 2 years has been a generator of meaningful positive cash flow for the total fund. And that's a combination of 2 factors. One is primarily due to the generation of income distributions from our private debt partnerships. Beginning in 2020, we had our private debt partnerships with roughly 75% of our investments start reinvesting income from the partnership. They distributed out to us as cash that can be used for the total fund. The other is in 2024, we had one manager in particular who exited some investments and helped generate some capital return to us in 2024. The bottom line is that it generates meaningful cash flow for the total fund. Going to move on to the next page, which is page 111. This is just a summary breakdown of how we're allocated. It's kind of hard to read a little bit, but our 3 biggest asset classes in terms of allocation are private debt, US corporate, European corporate, and then real estate and asset backed, that they can provide the majority of what we do in credit. And then we have a number of other sub asset classes that are shown here. The bottom line is a well-diversified portfolio. Keep going. If you move on, I'm actually going to skip over to page 114, which is the implementation plan, which is going to cover a lot of what was in the House view section. So this was presented and approved by our combined asset class committee, which is our internal committee, in January. We approved an implementation plan for 2025. And reiterating what I mentioned earlier, we believe this asset class can outperform the total fund's long-term target return of 7%, and the potential to outperform other asset classes like interest rate sensitive and real estate, for example. Most recently, no offense to real estate, but this asset class has done quite well. It's actually outperformed private equity over the last 3 years, and through March 31st, outperformed public equities, but that won't be true as of the June 30th period with a big rally in equities. But it's a solid, meaningful contributor to the total fund performance. We're targeting a net 9 to 10 long-term returns of our private investments, support that 9+% return. In this 2025 implementation plan, the credit team is proposing to increase our net commitments by up to 1.8 billion. That was approved by this committee to keep pace with the growth in total fund over the next 3 years or so. and targeting a 22% investment allocation. And I'll show how we build up to that 1.8 billion of commitment need to achieve a 22% target over time. Moving on to page 115, please. I mentioned earlier this asset class grew from 12.2 billion grew to 12.2 billion in fiscal 2024 from 6.6 billion in 2018. We always compare like, well, how did our allocation grow versus our forecast in the prior implementation plan? And we came in a little bit below target. We were at 12.2 billion invested as of June 30, 2024. We were targeting 12.4 billion. And we also came in a little bit below the allocation we wanted. We were targeting to get to be at 22% or 23% in the prior year. We came in below that because total fund grew more than we expected because of the growth in public equities. Bottom line is we're tracking a little bit below where we want to be in terms of target return. And that's going to be true for this June 30th fiscal period we're just about to hit. We're going to be about 12.2 billion invested. We were forecasting 12.5. We're not going to be there. Total fund has grown a lot more than expected because of the rally in public equities. We're going to be a little bit low in percentage. But that's going to move around a little bit as asset is deployed, as the allocations are deployed, and total fund grows depending on where public equities grow. So any questions on that before I keep on moving along? No, thank you. So right now we've got 17 strategies that are actively investing capital in the U.S. When we say actively investing and making new investments, we have a number of partnerships that are in liquidation that are returning capital to us. But what's actively investing for new opportunities, there's 17. We expect to add 3 additional strategies in 2025. In fact, we're very close to in final legal negotiation, and I'll explain 3 of these strategies that we're implementing to give a little flavor of what we're doing. So by end of July, we should have 1.4 billion of new partnership commitments out of the 1.8 billion, and then we're going to transfer 400 million of a private debt partnership that was in real estate. It's going to come over to us. So we'll have implemented by July this $1.8 billion plan. But to give you a flavor of what we're doing, so the 3 new strategies are as follows. One is an asset-based finance strategy. It's a strategy where the partner either lends against, makes direct loans, or purchases from another lender discrete pools of consumer or commercial loans, and where they can due diligence these loans with a high degree of confidence. And usually these structures are levered, meaning they borrowed money in some fashion to achieve a very high target rate of return. And we're targeting a 12 to 14% return on that strategy with a high degree of confidence that we can achieve that with low risk of loss. It's not something new we're doing. We're doing with another existing partner for about 10 years and have generated around 11% higher over a course of a much lower interest rate environment. So we have a high degree of confidence in the strategy. It should close in July. That's about 500 million. And then a second strategy we're close to closing in July with a $400 million commitment is a private mortgage strategy. These are privately originated mortgages for individuals with very high FICO scores, but don't qualify to be in the Fannie or Freddie Mae program simply because the individual tends to be someone who's a small business owner, for example, and they wouldn't qualify because they don't have a W-2 paycheck that would allow them to go into the Fannie or Freddie. And these FICO scores tend to be higher than Fannie or Freddie securitizations and with much better yields and credit spreads. And this manager has been highly successful in obtaining leverage on these highly diversified portfolio of mortgage loans through the securitization market. They tap it every month. And we're targeting a 14 plus net IRR I think it's a super attractive space to be in, and I credit John Trusiak, my colleague, for sourcing this opportunity, and we're close to finalizing that, hopefully in early July. And then lastly, we're adding a manager we know very well, an existing manager, to do a European direct lending partnership. It'll be our third European direct lending partnership, and they're going to use leverage on this portfolio, as we're very comfortable doing. They basically provide funding for leveraged buyouts in Europe, and have a 10+ year track record, and we're targeting a 12 to 14% net IRR. We expect that to close in early to mid-July. So that's to give you a flavor of what we're doing in credit in terms of new investments. Do you have any questions on that? I know it's kind of a lot to absorb. Thank you. So just moving on, I'm going to just touch briefly on page 117 about what we did this past year. So in 2024, we put together an implementation plan and providing for $950 million of new commitments. So this is looking backwards. And what did we do with that? We did invest that in new commitments of $950 million. We created a $400 million new fund of one partners with a top European investor that does risk sharing transactions. They're basically taking the risk of portfolio of loans from primarily European banks. And that's targeting a net 12 to 14% IRR. And secondly, we added $50 million to an existing fund of one partnership with a U.S. corporate lender. We have a long-term partner to do additional lending. And then we added $50 million to an existing partner who does maritime leasing of ships, very high return niche strategy. It's a leasing strategy for ships around the world. And then we added $150 million to a fund of one partnership with a European direct lender. And lastly, we reinvigorated an existing U.S. corporate lending partnership that targeted venture-backed growth companies, primarily technology-backed companies, and they receive equity, typically free equity along with these loans, and have a great long-term track record. It's targeting that 12 to 14%. So this is what we did this past year. So going forward, I'm going to skip over to page 120. So what we did is when we do an implementation plan, we forecast if we didn't do anything, what would happen to our investment in the credit asset class. So if we didn't make any new commitments, that over time, if the total fund grows, and we're assuming it's going to grow by 5% per annum, that our investments in credit would decline over time to about 20% of the total fund. So if we didn't make any new commitments, didn't make the $1.8 billion we proposed and get approved, that we would shrink and not be at a 22% target. So that's what this forecast goes into. I'm not going to go into detail on it, but happy to answer any questions. But as you go to page 122, so we estimated based on what would we need to do to make commitments to keep us at a 22% target for the total fund, which is our target for the new SAA. We believe we need to add $1.8 billion. That would be these commitments, as Paul described earlier, would be invested over time. We're assuming over a 3-year time frame. So if total fund is growing by 5% per annum, we need to add new allocations to new commitments to then be called down and invested by our partners over a 3-year time frame to kind of keep up with total fund. So that's where the $1.8 billion comes from, and the support is in the rest of the document. And I just want to stop there in the interest of time to see if you have any questions. Yeah, thank you. I just want to highlight one thing before I wrap up. This is on page 128, and this is regards to implementation approach. So we're focused primarily on fund-of-one strategic partnerships with a manager. We have, roughly 20 of them we've created over time, and we'll have over time. They allow us with customized terms that allow us to have a scalable commitment, meaning we could add capital to the commitment over time to grow along with total fund. That's very valuable to us in terms of meeting our long-term implementation plan objectives. We have an early termination right, which allows us to terminate the investment period, meaning put the fund into runoff. If we invest in a commingled fund, we don't have that right. It's a unique fund-of-one partnership term that gives us flexibility. If we're unhappy or if we want to move on from that manager in some way, we could terminate. It also gives us the power to renegotiate terms, the power to amend our legal agreement. It's a very powerful term to have. It equalizes the partnership in a way in which a pension fund like ourselves who chooses to invest in a commingled fund really has no flexibility. Once they sign the agreement, they have to live with that fund. And that's true in our private equity partnerships, that you have really limited influence or maybe no influence. So we have, it equalizes the relationship. And roughly about 90%, really more than 90%, probably more like closer to 95% of our active commitments are in these fund-of-one partnerships. So that's a key part of our implementation approach. And I'm just going to stop there to see if there's any questions. And in the interest of time, I wasn't going to go through any more of the implementation plan, but happy to answer any questions you might have.
Doesn't look like. Thank you all.
All right, thank you.
One comment I would make on the separate accounts is that Al highlighted in bullet point number 5. We have that same structure in real estate. So in real estate, we're actually even able to, after 1 year, terminate the GP. And we have done that. We pulled the trigger, I think about 6-7 years ago. It was a manager that was managing student housing for us. So there's something like 15, 16, 17 different university housing, multifamily apartments. The GP wasn't performing in line with what our expectations were. We terminated that relationship with them. We brought the assets in-house, and ASRS and RCLCO managed those assets and then slowly disposed of some of them. In some cases, we're receiving a premium. So that gives us that leverage, that opportunity, as opposed to being in a typical GP-LP relationship where if we're in the typical relationship, they draw capital. We don't know when the money's coming back. If we're dissatisfied with their performance, there's nothing we can do. We have to wait for the fund to kind of slowly wind down. Sorry.
So you may have answered one of my questions on the fund-of-one, how we can just quit or say we don't want you anymore, but the manager still has all those assets. So we take the assets over then? So you're firing the manager, but you're keeping the assets?
In real estate, we can do that. Yes, ma'am.
Okay.
In credit, I'm not sure we've ever done
But
that.
don't impute from this that typically the process would be that we manage the assets in-house. That was an exception. Typically, if we're going to turn off capital calls, that the manager would retain management of those assets until they ran out, correct?
In credit, that's what Paul describes. We can't take over those assets.
Okay.
So they just goes into runoff, and then they collect as the loans are repaid or investment is liquidated, then they return the capital to us.
Thank you.
And then finally, we'll circle back to me, page 153. This is preliminary performance for the total fund as of 5/31/2025. The value of the fund at this point is 58.2 billion. So that's a 1.6 billion pop relative to first quarter return. So a good rally. If you look at the 1 year, 3 year, 5 year, 10 year inception since date, all those performance numbers net of fees are above our actuarial assumption rate of 7%. So quite a change. Q1 ended with a lot of things that were happening within this administration, a lot of volatility and markets have come up as of 5/31/2025.
Scott, Paul, what was the total fund when you started here?
I don't have the exact number, but I'm trying to call it back, would be approximately 12 million. And I'll give you one other
I
date.
can remember like 30 from.
Oh, yeah, but no, it's approximately 12 billion.
Yeah.
And Mike gave numbers as of May 31st, correct? May 30th, sorry.
This is May 31st.
Yeah, if you round
Preliminary.
numbers forward as of today, the close of business last night, the expected rate of return or estimated rate of return is actually 8.9%. And then an extra $1 billion, the fund, so as a close of business last night, the estimated fund balance will be 59.3 billion, with the total fund rate of return estimated to be 8.9%.
And that concludes agenda item number 4, unless there's any other questions.
Very good. No questions.
Very much.
Item 5, presentation, discussion, appropriate action regarding risk analysis, investment compliance.
I guess for the record, Robert Butler, Investment Risk and Compliance Officer, happy to be between everyone and lunch. So I'll try to go quickly. On page 156, just the executive summary, I'm going to skip over our risk philosophy. It's the same slides as every previous presentation. And then like most of the other presentations today, all of the analysis is based on our portfolio as of 3/31 of 2025. And we'll jump to page 161 on our correlation report. I know it's been mentioned maybe by a few speakers, and John Trusiak's portfolio, the interest rate sensitive, where we are underweight partially because of not being super bullish on the return prospects. But as you'll see here, interest rate sensitive shows up in green, kind of highlighting the correlation benefits of interest rate sensitive compared to our other asset classes. Move to page 162. And on the left, we have our investments by dollars allocated percentage wise. And then on the right is the contribution to volatility. You'll see that public and private equity contribute a major part of our overall volatility. However, as noted in probably every presentation I've done, this is a lot lower contribution to volatility from equity than you would see in many other pensions, and especially in a 60-40 portfolio made up of 60% equities, 40% bonds. If you run this same analysis on that portfolio, you actually get about 99% of the volatility comes from equities. And then I'll skip to
The punchline being that the portfolio is pretty well diversified.
And I'll skip to page 165. And want to emphasize again, this is not what actually happened. This is taking our portfolio as of the end of March, hypothetically how it would have performed in these previous crisis scenarios. And in almost every case, it would outperform our benchmark portfolio. And you see that outperformance in the light gray bars, which shows the alpha or outperformance based on either asset allocation tilts or manager selection, just overall value add from the investment staff and consultants. Skip to 168, I think. Yes. So I was going to skip this one since Cole includes our top 10 equity allocations, but since we had a question related to this earlier, so this obviously instead of our top 10 is our top 20. And you'll see that Alphabet's combined into one because this is more of a look through on the exposures. And this would also pick up any of the corporate bonds that John Trusiak buys in the interest rate sensitive portfolio. And there's not much impact from the corporate bonds, but just thought I'd bring this up. Then we will skip to 169, I guess just next page. Again, you'll see here that we are our own largest manager, a little over 30% of the portfolio. And then obviously we have a significant amount of assets with both BlackRock and Legal & General. And that's primarily for our non-US equity exposure. And as was mentioned previously, it's in enhanced index strategies. And then on 170, the next page, a few of these names were mentioned earlier. So you'll see Mill Creek that Mike Copeland touched on as our second largest real estate relationship. And as a couple of people mentioned, in both private credit and real estate, we have the separate account structures. And so you'll see kind of as part of that sort of much more concentration with our top managers than we have in private equity. And in the interest of time, I'll stop there on risk unless there's any questions. Let's go to page 175, moving on to compliance. And my quick summary is there were no glaring red flags or areas of concern as far as compliance. Go to 177. There were no exceptions on the pre-trade compliance. This is basically in Bloomberg, we have rules set up to make sure that Cole and Vicente are following our own rules, policies, and procedures, and to prevent any sort of like fat finger mistakes if, put in too big of a trade or, leave your finger on a button too long. So no concerns there. Get to 181. And Bank of New York Mellon is our custody bank, and they run actually a daily compliance report for me. And then also they do a deeper monthly report, and there were no issues or major concerns there. Just a few minor things that typically get flagged when like a company spins off a division and then it shows up in our holdings, not yet in the index. So it gets flagged and I see it, I'm aware of it, but it's not a concern. And usually gets added to the index later, or we ended up selling it. And then page 182. And again, stop me if I'm going too fast, but I'm getting a little hungry. Maybe everyone else is as well. We heard from RCLCO earlier, our real estate consulting firm. They do a review of our real estate partnerships to make sure that they are basically counting the numbers correctly, following our policies and the policies that we've implemented with them. And on 183, we have the summary of their reviews. The 2022 review had been completed. The 2023 review is in process. There's been 3 completed so far, within there 19 to go, and no major issues have been found. And then I'll just jump to 185. Makita is another one of our consulting firms. They do a similar review of our private equity and private credit investments, but they do more of a sampling process because we have maybe 300 or 200 or so of those investments. And so they typically review about 30 a year, but they'll go back and review every year that hasn't been reviewed, if that makes sense. So it's not just a 1-year review, it's all past years that have not been previously reviewed. So it does take a while to do these reviews. And so they have completed the 2020 review. No, apologies. There's one more to do for 2020. 2021 has been complete and 2023 is in process. So many compliance reviews ongoing. And with that, I'll stop. See if there's any questions.
Thank you, Robert. Okay, moving on. Summary of current events. I don't want to jump. Are we completed that agenda item, Michael?
I think that would have been Mr. Pecunis would have, I think, come up with that. That was his agenda item, I believe.
Current events, if we don't have a budget in a couple of days, we're in trouble. But that would be a current event. Mr. Mattson, anything from you?
Nothing in addition to that. Thank you, though.
That's a relevant current
Yeah,
event
There you go. Yeah. Call to the public, or we have anybody here to,
No, we do not have anyone wishing to speak.
very good.
Mr. Chair, one thing I do want to highlight, I usually have a slide in here, but it didn't make it this particular time around. I want to call out to our mid-office, back office staff. It's Lupita Breland. Raise your hand, Lupita. And Evan Smith, he's performance, and James Smolwicks. Becky Fox is not here. She's telecommuting. But these folks are the glue that keep the private markets together. We're invested 50% in private markets. They're responsible for making sure all the accounts are right, the cash flows happen, the cash flows coming back, performance measurement. Without them, we'd be lost. So I just want to kind of call out to them and say thank you for their work. They never come up and present. But I want to thank them for the work nonetheless. We couldn't get these returns. We couldn't be able to have these returns without them. So thank you.
Thank you.
Yeah, thank you very much. Board member, executive director requests for future items. Assume that none of those. Next meeting of the investment committee will be October 1st, 9:30 here. Do I need a motion to adjourn or just?
No.
Okay. All right, no further business. We will adjourn the investment committee meeting. Thank you very much for presentations. Great work.
Thank you.
Thank you, everyone. The time is 11:27.
About the private.
Just a quick question, if either of you want to touch base on any items? No? Okay. Well,